Don't you think that Wall Street kind of doesn't match Main Street right now? I mean, if you take a look at the stock market, ever since the beginning of the pandemic, it's just pretty much been up, 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 and up and up. But like if you take a look at like the Main Street economy, you've got high inflation, supply chain shortages, a labor market shortage, and what seems to be kind of a wide, pretty big deal of problems that are going on. So why is it that you might wonder that the stock market is still just going up, up, and up, and up, and up? Government stimulus? No, not really. Well, of course, that is a little bit part of it, but one of the bigger issues is the low interest rate environment that we're currently in right now. So the low interest rate environment deals with debt. Debt deals with bonds. Interest rates basically are an example of what a bond would yield. This is important because investors typically have one of two methods of investing, that is through the stock market or equity investing or the bond market. So with this current low interest rate environment that we're in, that means that naturally bond yields are also going to be lower. Because we have record low interest rates, this means that the US Treasury bond, if you currently look at the 10-year, I believe it is yielding a 1.4% rate of return. This means that every year on that bond, you will earn 1.4% interest. Now, inflation for 2021 just came in at 6.2% or something like that, in the 6% range. Do you see a problem with that? Yes, if you did the math on that, that would mean that if you invested in what is known as the risk-free rate of return, which is a US government treasury bond, it's risk-free, okay? The yield on that is actually negative, right? 6% minus 1.4% is negative 4.6%. So in buying that bond, in fact, you are losing money. So therefore, investors start to steer away from the bond market and they need to chase a higher rate of return in order to beat the current rate of inflation. And how do you do that? You have to go into riskier markets like the stock market, which is investing in equities, right? Investing in equities of company. That is also kind of see why you've seen this take off in crypto still in 2021. Investors need to do something with their dollars and they can't beat inflation currently in the bond market, especially not in the US Treasury market. And that right there will cause a flow of money to go into the stock market, causing more and more people to continuously buy stocks. Demand for stocks is rising, so the price of stocks continues to go up. So, until we see that trend start to change where we see interest rates go up and we see those treasury yields start to rise again, then we will maybe start to see a flow of funds come from the stock market and go back into the bond market. And then maybe you'll kind of see the stock market correct itself a little bit further. But I think that is one very significant reason why you are currently seeing Wall Street somewhat stray pretty far away from Main Street in the sense of just overall economic perspective. Main Street, high inflation, supply chain shortages, labor market shortage, it's just not necessarily looking good. Wall Street, if you look at your portfolios, they're like near record highs. How? The flow of money. Interest rates matter. Bond yields matter. Right now, inflation matters. Right now, investors need to find a way to beat inflation. Like I said, there's only kind of a couple ways to do that right now with the higher rate of inflation of 6%, and that is in the stock market. That can be in the crypto market. I'm just saying investors need to find a way to beat that rate of inflation, and you won't see that flow of funds start to return to other things other than the stock market until interest rates go up, bond yields rise, so on and so forth.